The headline is always the same. Markets crash, gold soars. When stock portfolios are bleeding red, when cryptocurrencies are volatile, and when the global economic outlook feels like a dark storm cloud, investors around the world perform one predictable maneuver. They rush toward a shiny yellow metal dug out of the ground. It seems counterintuitive. Why does a non-yielding industrial commodity become the most sought-after asset when the financial world is on fire? Why is the price of gold hitting record highs during periods of high inflation, war, and political paralysis? The simple answer is fear. The complex answer is a 3,000-year-old story about trust, physics, and the fundamental limitations of modern fiat currency. This is the explainer on why gold is the ultimate safe haven asset and what that signals about the future of our economy. First, let's establish a core definition. What exactly is a safe haven asset? A safe haven is an investment that is expected to retain or increase in value during market downturns. Crucially, a true safe haven must have a low or even negative correlation to risk assets, like stocks and corporate bonds. When everything else zigs, it zags. Gold's unique position stemmed from its identity. A stock is ownership in a business. A bond is debt. Both require an underlying counterparty, a company or a government, to fulfill a promise. Gold, however, is simply physics. It is a physical element that cannot be destroyed, diluted, or defaulted on. This physical, tangible nature is the first layer of its protective shield. Gold's rise in instability is driven by three interconnected forces that directly challenge the integrity of the modern financial system. Reason 1. The inflation hedge, gold versus the printing press. The most immediate driver of the gold price surge is inflation. Inflation is the decrease in the purchasing power of money, often caused by governments or central banks printing too much currency or expanding the money supply too quickly. Think of it this way. Fiat currency, like the US dollar, the euro, or the yen, can be created infinitely with the push of a button. When governments need to pay debts or fund stimulus packages, they print more. The more units of currency exist, the less each unit is worth. This is the source of inflation. Gold is the opposite. Its supply is scarce and finite. Every ounce of gold ever mined is estimated to be around 244,000 metric tons. And while new gold is found, the rate of discovery, the above-ground supply, is incredibly slow and stable. Therefore, when the dollar loses 5% of its purchasing power in a year due to inflation, the dollar price of a fixed asset like gold must increase to reflect the true preserved value. Gold is not getting more expensive. The dollar is getting cheaper. Gold becomes a stable yardstick in a turbulent sea of expanding paper money. Reason 2. Lack of counterparty risk, the solvency factor. In times of extreme crisis, like a banking collapse or a sovereign debt crisis, investors panic about who owes them money. If you hold a bond, your money is tied to the solvency of the issuer. If you hold cash in a bank, your money is tied to the bank's stability. Gold carries zero counterparty risk. It is an asset held free and clear. If you hold a physical gold coin or a share in a gold-backed ETF, you don't need a third party's promise of repayment. There is no risk of default, and crucially, there is no risk of bank runs or bail-ins, where your assets might be temporarily frozen or taken. This makes gold the definitive asset when trust in institutions evaporates. Reason 3. Historical and universal trust. Gold has been used as a medium of exchange and a store of value for millennia. It transcended empires, currencies, and continents. It is one of the few assets instantly recognizable and tradable in almost every country on Earth. When geopolitical tensions escalate, such as During wars or global trade conflicts, the stability of national currencies, especially those of sanctioned or warring nations, is compromised. Gold's universal acceptance makes it a highly liquid, neutral currency that can be moved across borders or used to settle international payments where the local currency is distrusted. This historical legacy reinforces its status as the default asset of global, non-governmental finance. To understand the power of gold, we must look to history's breaking points. The Great Depression and the dollar's devaluation, 1930s. During the Great Depression, the U.S. government, under the gold standard, was technically limited in its ability to print money. But the panic was so severe that trust in the banking system completely collapsed. In 1933, President Roosevelt effectively banned the private ownership of gold in the U.S. and then devalued the dollar by raising the official price of gold from $20.67 to $35 per ounce. This single action proved gold's function. It was revalued upward by over 60% to reflect the lost purchasing power of the dollar, offering protection for the government at the time against monetary instability. The stagflation of the 1970s. This period saw the toxic combination of high inflation and high unemployment. When President Nixon ended the gold standard in 1971, the dollar became a purely fiat currency, paving the way for the printing presses to run freely. From 1971 to 1980, as confidence in central banks plummeted, the price of gold skyrocketed from $35 to a peak of over $800 per ounce. It was the ultimate demonstration of gold as a hedge against catastrophic monetary mismanagement. The 2008 financial crisis. The crisis wasn't about inflation. It was about the solvency of complex paper assets like mortgage-backed securities. When credit markets froze and trust in the major banks vanished, investors dumped paper assets and rushed into physical gold. The price surged from around $700 an ounce in 2008 to nearly $1,900 an ounce by 2011. This was the flight to liquidity and simplicity, a panicked realization that complex financial products were simply not as trustworthy as a simple bar of gold. Beyond the historical psychology, modern market mechanics are reinforcing the gold narrative. Central bank buying spree. In recent years, central banks globally, especially in developing economies, have been accumulating gold at record pace. This move is primarily a diversification strategy to reduce reliance on the U.S. dollar as the world's primary reserve currency, signaling a quiet but profound distrust in the global geopolitical order. Interest rate mechanics. When the Federal Reserve raises interest rates, it makes interest-bearing assets like government bonds or money market accounts more attractive, which raises the opportunity cost of holding non-yielding gold. Conversely, when the Fed cuts rates, often a sign of economic weakness, the opportunity cost of holding gold falls, making it instantly more attractive and leading to a surge in demand. The final caution: gold is an insurance policy, not an engine for growth. It generates no yield, pays no dividend, and its price can be volatile in the short term. However, the enduring truth remains: gold is the asset of fear. When central banks print money without restraint, when geopolitical conflicts rage, and when investors lose faith in the promises made by governments and corporations, they turn to gold. Its rise is a tangible measure of how much trust the world has lost in the stability of the modern financial system. What other assets do you consider to be a safe haven? Let me know in the comments below.
If you enjoyed this video, hit like and subscribe for more amazing science. And as always, stay curious.